was that, even though Bitcoin is volatile, because it's a non-correlated asset, when you add non-correlated assets to an investment portfolio, even though it's volatile, it actually reduces the risk and reduces the volatility in investment portfolios. And so asset managers today are starting to realize that. And so if we look at the next chart, these are numbers just going over the past 5 years. So we went through the crypto winter, and we want to compare investment portfolios with Bitcoin to investment portfolios without Bitcoin. So we just took a standard 60-40 portfolio, so 60% stocks, 40% bonds, and no Bitcoin, and looked at the performance over the past 5 years. And this portfolio averaged about 11%. And the volatility was, a little bit around 7%. And then the maximum downside was 21.6%. If we compare this same portfolio, but take 2% out of stocks and put it in Bitcoin, so you have 58% in Bitcoin, 40% in bonds, 2% in Bitcoin. If you look at the returns of that, it went up dramatically, up to over 13% annualized. The volatility just barely changed. But if you look at the maximum downside, a portfolio with Bitcoin had more protection than a portfolio without Bitcoin. Okay. And when you compare the returns versus the volatility, you come up with what's called a Sharpe ratio. So a Sharpe ratio compares what are called risk-adjusted returns. And so if you have a portfolio with 2% Bitcoin, your risk-adjusted returns, or your Sharpe ratio, goes up dramatically. And if you put 10% of your portfolio in Bitcoin and cryptocurrencies, your Sharpe ratio goes up to like 176 versus about 110 or so without it. And so so what this means is that professional portfolio managers, fiduciaries, and people who are responsible for managing money, in my opinion, they're almost under a fiduciary responsibility to add a small amount of Bitcoin to their portfolio because it increases the risk-adjusted returns for these clients.